Hey guys, RC Peck here, and I am outside, so if you hear outside noises, it's because I'm outside. Hey guys, this is my weekly investment thought, and when I started really investigating this whole investment world thing, I noticed that I did not see any greed, but I saw these two types of fear going on. One was this fear of just losing money, and the other one, which was as powerful, was a fear of losing out on the next big move, right? So, and what I noticed was there's these two kind of opposing camps that were really driving this fear cycle. On one side, there was this long only big box like advisor just driving this idea of fear. So in order to eliminate that fear, you got to really diversify and rebalance, and oh, by the way, let us do it. On the other side of it was this pick of the month newsletter industry, that their fear was the fear of losing out. You've got to get this and find the next Google of China, the next Facebook of Argentina, the next Microsoft of Europe. They were really pushing and still are pushing this whole fear of losing out. And people get stuck in this fear cycle, and it's that fear cycle that's hurting them. Now, if that's not enough, and one of the things I want to talk about with you this weekend is this idea that is even more painful than the fear cycle. And it's this idea of being self-righteous, right? It's not enough anymore for the stock market to go up. It has to go up for the right reason. And if it doesn't go up for the right reason, your moral superiority of what should be the right reasons keeps you out of the market, or keeps you in a stock that is falling 30, 40, 50, 60, 70, 80, 90% because of this self-righteousness. So I want to pull the curtain back a little bit on this self-righteousness and just show you how between the fear cycle and this self-righteousness that is running in people, that it's absolutely destroying people's future. So let me get behind the computer and get my PowerPoint so I can show you what's going on this week and show you how these ideas are absolutely hurting people and how you can shift them. So give me a second and I'll speak to you then. Okay, hold on. All right, guys, I am behind the computer. This is episode 403. So good to have you here. The image I most think of when I think of the stock market is the ocean. And I picked this one because it is scary, not to scare you, but I have a couple reasons why I want to show this image to you. And the first is, the more that you can think of the stock market like the ocean, the more your money is going to grow, the more it's going to be aligned with the market. And what I mean by that is, I don't think anyone stares at the ocean and says, "You're wrong," or "You're wrong now. You were right before, but now you've just been too stormy. You shouldn't be stormy this long, or you shouldn't be calm this long, or you shouldn't be whatever this long." I mean, people don't do that when they look at the ocean. It's the ocean. It's not broken. It's never been broken. Same thing with Mother Nature, right? Mother Nature's not broken. So when you think of the stock market, think first, oh, this is the ocean. The ocean is always right. Now, it's my job to figure out whether I should be on the ocean or not, but the ocean's never broken. And the more you can think of the stock market like an ocean, the more your money is going to grow. Now, this next image is comparing the international stock market. So this is international developed markets, ex-US, against the S&P. And this is what they've done this year. So international, now it's of course international from a US domestic point of view, but international is up about, and this is international developed, is up about 18% during the exact same time period. The market, the S&P 500, is up about 11%. It's right. The market is right. It's right that international developed is going up more than US domestic. Now, is it going to continue to go up? Should you be in it? Should you not be in it? That's a separate conversation. But what I want you to get is the market is always right, even if it then turns around. And right now, so far this year, it's saying, hey, international developed is the place to be over the S&P based on what's actually happening. Now, next one. This is one of my favorites just to show you, is Tesla being compared against Ford. Tesla's the bluish line and Ford is the red line. Tesla shouldn't go up. Tesla only sold 80,000 cars. Ford sold 80 million cars. Ford has $6 quadrillion in revenue. Tesla had $1 in revenue. I mean, whatever the numbers are, it doesn't matter. So it's not about you being, this having this unfound certainty and being totally correct and taking the morality, the moral superior road, that's going to hurt you. If you don't think Tesla's going higher, or you don't want it to go higher, or it shouldn't go higher, that means your opinion is wrong if it's actually going higher. Because the market is never wrong. The market is never wrong. So look, Tesla's up year to date 52%, and Ford year to date is up 0%. That's what it is. We're not talking about what should or shouldn't happen. We're just looking at what is happening, and Tesla is moving higher. The next chart, I just wanted to show you the S&P 500 versus oil over the last 3 years. And this price chart compares the two over the last 3 years. The red price line is the price of West Texas Intermediate crude over that 3-year period. It's down about 55%. Oil today is right around $47. And during the exact same time period, that blue line, which looks a little purple, is up about 33% over the exact time period. There is no what it should do. There is no moral high ground. There is no oil should be at this price or the S&P should be at this price. The more you have opinions, the more you're going to get surprised, and the more that surprisingness is going to hurt you. The more complicated your approach, the more times you're going to get surprised, and the more times you're going to get hurt. You have a simple, straightforward approach, it is much harder to get surprised. I don't know whether oil should go up or down, but it's having a hard time, and it is looking for its base. Maybe its new base is $45 a barrel. We don't know yet. We will know, but it is definitely looking for something in that $40 range right now. S&P, whether you want it to go up any higher, whether you believe it should go up any higher, it is going from lower left to upper right. The next price chart is comparing value stocks against the S&P 500. Now, on the screen, this price chart is showing you a relative comparison between S&P value stocks and the S&P 500. So basically, if this line is falling, which it has been since 2007, that means value stocks have been underperforming the S&P 500, and they continue to underperform the S&P 500. Now, if you go and approach this with this self-righteousness of this unfound certainty that you're totally correct, that value and deep value stocks should be doing better, and you have this just moral superiority complex, well, then you got a leak in your portfolio, because that self-righteousness is hurting you, and it's hurting a lot of deep value and value players who are pounding the table saying, but deep value is good, but deep value is good. Guys, it's been underperforming the market since 2007, and that trend looks very entrenched right now and actually looking to accelerate to the downside. Then we have the most loved stock of 2017. Now, I typed into Google most loved stock 2017, and there were a handful of them, but one of the top ones, and I mean the top 3, was a company called Verizon. And all the chitter chatter and the noise machines were talking about the potential merger and acquisition of maybe Verizon buying Walt Disney or Charter Communication or Pandora Media, because they had already purchased a large portion of a section of Yahoo. I do not believe they bought every single part of Yahoo. And so people were just, we got to get Verizon, and people have been buying Verizon. Now, if you look at this price chart, this is a relative price chart comparing Verizon against the S&P 500. Guys, this price chart goes back to April of 2012, 5 years ago. It has been underperforming in a very stable, steady, consistent manner for that time period. And that underperformance has been accelerating over the last 12 months and is continuing to. When you eliminate the noise, when you eliminate the self-righteousness, when you eliminate the fear cycle, when you realize the market is the ocean and it is right, it is never broken. And guys, just when I say the market is always right, I'm not saying that it is efficient and you can never beat it. Of course you can beat it. There's so many inefficiencies. It is driven by humans who are very inefficient when it comes to growing their money, and there's groupthink, and there's just deep fear between the fear of losing out and the fear of losing money, that fear cycle that the long-only big box advisor industry pushes and the pick of the month newsletter industry pushes. You can step aside from that anytime you want and get out of the fear cycle and go over to the other side of the river where it's stable and consistent and steady. Now, last week I showed you a price chart of bonds, and I wanted to show it to you again. So this is a price chart of bonds going back to 1980. The very bottom of the chart is showing you the yield of the 30-year. Now, this is a price chart of the 30-year bond, but I'm showing you what the yield was when the price was at the level it was. And this is a pretty neat price chart, because you can see from the bottom of 1982, when the bond bull market started, the 30-year bond yield was 14.5%. Fast forward to 1999, and the 30-year bond was yielding 4.8%. Fast forward to March of 2009, that 30-year bond was yielding 2.6%. Fast forward to just recently, 1 year ago, and the 30-year was yielding 2.13%. I told you last week, this price chart will not go to the heavens. There is a law of diminishing returns. There's a point where it will not go any higher, because what's in front of this price chart is a 0% yield for the 30-year bond. Now, I'm not saying it can't go negative on the 30-year. I'm saying that's getting pretty close to the 4-minute mile, right? There's, 1,000 people on the planet in the last 5 billion years who have run faster than a 4-minute mile. But you literally could probably memorize all of their names. I'm guessing that there's 1,000 people who have run faster than a 4-minute mile. Maybe it's actually only 200 or 300. The point is, there's an upper limit to this price chart. And that upper limit is going to be somewhere around a bond, a 30-year U.S. Treasury bond yielding 0%. The market is always right. The market is always right, just as the ocean is always right. You don't have to like the reason. You don't have to believe it should go higher or lower. It is what it is. And the more straightforward your approach can be, the less you will be surprised, and the more consistent and stable your money will grow. And it's that self-righteousness that bonds will go up forever, that total certainty, that moral superiority that it's true, is going to crush the futures of so many people over the age of 60, because their long-only big box advisor who looks at their age and their self-described risk tolerance says, nope, you're going to be 50% bond, 50% stock until the earth burns down. And that is a huge mistake, and that is going to hurt people. I want to end with this. It was actually an email that I got from Seth Godin, not personally. Seth Godin, if you don't know him, has a great, great daily email. And I know many of you are probably already reading the screen, but could you just close your eyes for a second, because I want to read this to you. Anticipating doom is brutal, and anticipating brutality is even worse. It creates an enormous amount of emotional overhead. It makes it difficult to invest, hard to make long-term plans, and it fills us with dread, short-circuiting our futures. Peace has a dividend. Economic peace, political peace, interpersonal peace. It gives us room to dream and to make things even better. Most of all, peace of mind pays huge dividends. And I have a link to that blog post. Guys, the gloom and doom, the world is ending. That anticipating doom is so brutal. And anticipating that brutality, anticipating the crash or the bubble, it's even worse. And that's what's killing people's futures. And Seth Godin hit it out of the park with his blog post, one of his blog posts this week. This is why I pound the tables about, get a simple, powerful, straightforward approach. You know, those who have my research and have done the training, that it's so powerful and what real peace of mind feels like. It is a life changer. It is a game changer. It is powerful. And Seth Godin figured out. And I have to say, when I read this week, I'm like, I wish I had read that. I wish I had written that. It is so powerful. Print that out, put it on your wall, and realize every time a gloom and doom person does that to you, just notice the brutality of how that's hurting your future. So what is the takeaway? Number one, guys, markets are always right. I made a reference, or I thought I made a reference. I probably made it in my head. But this guy, Ben Carlson, who has a weekly, it's actually not a weekly blog. He blogs 2 to 7 times a week. He had a blog posting that says markets actually are mostly right. And I read it. It was like, it was great information. But what I thought was, no, markets are always right, even if you're surprised. And the idea is to get a position and get ready to be surprised. Markets are like oceans. They're always right. Number 2, guys, you don't have to like what's going on. You don't have to like that the bond bull market will be coming to an end, not in your lifetime, but probably in the next 18 months. You don't have to like it. You don't have to be self-righteous about not believing it. What's most important is to align your money with what's actually happening. And lastly, guys, Seth Godin, man, my brother, you hit it out of the park. Gloom and doom is brutal. Brutality kills futures. Peace of mind is powerful. How do you get peace of mind? You get yourself an incredibly simple and powerful approach. And like Da Vinci said, simplicity is the ultimate sophistication. You want a sophisticated approach? Make it powerful by making it simple. And do not confuse the word easy with simple. They are not. You know what easy is? Making something really, really complicated. That's easy. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, if you like these weekly thoughts, please forward them to friends and like them, because they make a difference, or it makes a difference when you do that. And if you want investment stability, but you are tired of the hype and the BS and the overwhelm and all that noise from the noise machine and the long only, big box, or the pick of the month industry, just let me help you become the smartest investor in the room, so you can just stop drowning in the drama and the distraction. I'll give you the principles for free. I'll help you create that filter barrier so you can have that peace dividend that Seth Godin was talking about. Guys, what you need to do is upgrade your investment peer group. Thank you for being in my world. You are the best, even though I don't know most of you or the majority of you, and I appreciate your attention, because that is the most important and scarce commodity on this planet, is your attention. Thank you so much. You guys take care.